So good afternoon, everybody. I'm Neal Watson, a certified financial planner practitioner here in Marietta, Ohio. We're waiting on Daniel Spurgeon to join us here shortly. We'll go into a couple of things as we talk about what's happened in the market so far during the first half of this year. And one of the things that we are going to talk about is the performance of both the stock and bond markets during the first half of the year. So the S&P 500 was has been up about 15% during the course of the year. And we will kind of put some stuff up on our screen here and go from there so you can kind of follow along with what we're talking about. Dan's getting ready to jump on here.
Sorry, Neal.
No, all good.
Having
All
technical
good.
difficulties this morning.
It happens at times. I'm having a couple myself as well. So let me jiggle my screen here a little bit. So you just got back from vacation. How was that?
It was warm, but very enjoyable.
Good, good. Little beach trip.
Yep. We went
Yeah.
to the Outer Banks, and my youngest daughter got her first exposure to the beach at a year and a half, and she was not a fan of the water. So,
It takes a minute or two for that to happen,
yeah,
and they they tend to adjust as they go if you can kind of gradually get them into it. So
sure.
we started talking about here the S&P 500 year to date's up about 14.5%. The Dow's up about 379. Although it's not shown here, the NASDAQ composite's up 18. Bonds have struggled a little bit during the course of the year. They're off a little, and that's because interest rates haven't done anything. We've been expecting some interest rate cuts that have just not materialized. Mid caps and small caps, and we're going to talk about that here in a minute, have not done well. So, Daniel, I think one of the big stories that continues is the Magnificent Seven and how they've kind of led everything higher. And on our screen, we have some numbers about this. The Mag 7's up 33%. And if you look at the broader market without them, it's up about 5. So we've heard some things. What are some things that you can tell us about what to expect from these going forward and how this is impacting things?
Yeah. So, well, we've obviously we've had a few due diligence meetings with a few different fund managers and/or asset management companies, and working with their teams of analysts and their outlooks. And there's definitely some concern with the concentration of return for how long it has been, and most firms are anticipating a broadening of the market, some sooner than later. Meaning more investments or more companies within the broader indexes contributing more to the overall index return rather than the top 7 or 10 companies. But there's still, if we look at the primary driver of future stock returns, it's company earnings and their growth. And if you actually look right now, where, as you see in the top right there, Neal, earnings growth with some of these companies is still, despite their crazy run-ups over the last 10 years, their earnings growth is still far outpacing the average earnings growth of the overall broad market. So, again, the markets can run a lot longer and more irrationally than we may think is possible. But we're definitely not. We've trimmed a little bit of our earnings over the last month as we've seen rebalances. But we're not shying away from the top holdings of the S&P right now, just because of what we're seeing from an earnings and growth perspective.
Yeah, and I guess one of the things that most people should be wary of is if the market consolidates or the laggers tend to catch up to the ones that have ripped higher already, doesn't always mean that the ones that have been lagging behind will just significantly perform well. It could mean that those at the top could come down in price and adjust downward that way and consolidate in that manner. And that's never a very fun thing to go through either.
Right.
One of the key things that we've seen is valuation. And we know that where you buy in terms of the stock market has a pretty significant impact over the next several years of what market values will be going forward. And we're getting a little bit on the pricey side here. Daniel, talk to us about this a little bit. And the Mag 7's impacting this as well. And we're going to show a slide about that here next. But why does this concern us?
Sure. I mean, you just look historically. So PE ratio being price to earnings ratio is just historically standard way to value a company, whether it's overvalued or undervalued. And it's not the gospel. It's not always a 100% correct predictor. But what we have seen historically is as companies' PE ratios get very high, as you can see back in 2020, and you can go back to the pre-tech bubble burst in the late 90s, you saw the PE ratio rise up to 24 times. Um, that's tended to precede pretty substantial pullbacks in the market. Because again, as companies become overvalued, whether that be overbought or again government stimulus pushing more money into the economy, that's caused things to run up more than potentially what their actual earnings growth would warrant. So again, we're a little bit concerned on that front. And again, as you see, PE ratios, you see a sell off in the market. The P on the PE, the price of those stocks comes back down. That ratio becomes a little bit more fairly valued, and then you typically see a rebound back up. So that's again, our fortune telling skills are just as bad as anyone else's as far as knowing what's going to happen. But with higher PE ratios, it can signify or signal that we could be running into a little bit of a slower growth period, because eventually companies do become overvalued and we see a correction.
Yeah, and I guess one of the key things is we talked about those Magnificent Seven. They're about 8 of the top 10 holdings in the S&P 500, and they are right there at the full 7 holdings of the Nasdaq Composite Index. And the PE ratio is also being pulled higher by these companies. Those top 10 companies in the S&P 500, as you can see on the screen here, are trading at 30 times earnings, which is very rich. The remaining stocks are probably fairly valued based on historical standards. If that historical PE ratio is in that 16 range, we're 17.6. That's not awful for the other 490 companies that make up the index. So there's some concern at the top there that we see in that regard. The economy's been doing okay during this time frame, and I know there's a lot of concern that we were talking about a recession a year ago and all that stuff. And I think one of the things that I find interesting is that 2/3 of our economy is driven by consumption. And one of the things that I've heard in some of these meetings and some other have read some other places is the consumer drives this. And with employment being as strong as it is, we tend to expect things to continue to do quite well. Do you have any thoughts on this?
I totally agree. As long as people are willing to spend, that's yeah, I totally agree. I think things will continue to move forward. We still have I know inflation's come down, but you still have earnings a little higher than expected or desired earnings inflation. And I understand for folks watching that they may feel like, hey, my wages still haven't kept up with cost of living, and we totally agree. But folks are getting paid more now than they were 5 years ago, substantially more, and people are still spending. And I totally agree with that sentiment, Neal.
Yeah, and the consumer's in a pretty good spot too. When you look at their debt payments as a percent of their personal income, in 2007 it got very lofty at 13%. Now it's under 10%. So it's not
Mm-hmm.
it's not all-time lows, but it's certainly very manageable. And we have seen some credit card and some auto loan delinquencies start to move higher, and that is concerning a little bit. But at the same time, with by and large, with the debt service ratio, there's still some room for that consumer to continue spending as they have, and especially if they're working. And the labor market is extremely tight.
Mm-hmm.
So we always get into the idea that we're always looking at a bear market around the corner, and we all know that. And it's important to have long-term perspective. And this chart basically shows that in any given year, your range of returns for stocks or bonds or even a traditional 60/40 are all over the place. But as you get into longer time frames, the more likely it is to have positive results. And we know that the election's coming. That's always a good topic, and people are concerned. People are concerned about the economy. This chart does a great job, Daniel, of showing just how important it is to maintain a long-term focus, doesn't it?
Yep. Sorry, my screen just cut out. No, absolutely. Yeah. The your probability of losing money or making money in the short run dramatically increases, and the longer your time horizon is. It's again, I'll never use the G word. Nothing's guaranteed in our world except death and taxes. But the longer your time horizon, the probabilities of success dramatically increase.
Absolutely. And this is one of my all-time favorite charts here. And I didn't realize I got the disclaimer in the wrong spot here. But on average, we have a 14% correction each year over the course of time. It's never really right at 14, except for a small handful of times. So far this year, we've only had a 5% drawback. So we
Mm-hmm.
could be in for a little bit of volatility going forward. And I think that is something that we will uh, face as we get closer and closer to the election and there's a result that's known. And I really don't want to bring politics into this by and large because it's kind of pointless to do that. But as some of the things that we've heard in some of these meetings that we've had, what are some key takeaways that you've had from that?
Um, yeah, actually, I mean, on the political front, most most of the research firms we work with think that the outcome of the election this year will be relatively benign as far as, or just not a big deal one way or the other, blue or red. Neither team wants to see the market crash. And, to your point, some of the points you had earlier is, earnings are pretty strong for still a pretty good portion of the overall market. Labor force is tight. Spending is still high. There's still some of the economic and macro trends still look really strong. We continue to get bombarded with the Federal Reserve and what are they going to do with interest rates and where's inflation, but they've made a lot of progress on inflation rate. Now, obviously, again, prices have not come back down to what they were pre 2020, but the rate at which prices are increasing has dramatically decreased over the last 8 months, which is good. There's a lot of positives in the market. I wouldn't be surprised if we saw some volatility to your point, just normal market fluctuations. To see a 10 to 20% swing is not abnormal.
Right.
If the election or the news media happens to be the catalyst, that's fine. But if you look historically at election years and the year following, they're not always 25-30% drop years. In fact, they're usually positive, which we're well
Right.
on our way to that this year. So,
Right.
I think if we see volatility, whether it's correlated to the election or not, it'll probably get tabbed as election caused. But we're not putting a lot of stock or fret and time into, is Biden going to win or is Trump going to win or who's even going to represent either party. It doesn't. 10 years down the road, it literally doesn't matter.
Right.
So we're still focused on long-term outlook and focused on managing volatility and managing risk per each client's risk profile and goals. So part of it.
Yeah. And one of the great things that I think's happened this year is it's all happened in spite of not seeing interest rate reductions. Earnings have still been good and projected earnings next year are
Right.
still strong. And we haven't seen those interest rates come down. And, from a bond market perspective, it's maybe hurt the bonds a little bit. We haven't
Mm-hmm.
seen a lot of increase in that. The yields basically offset the price decrease to this point, give or take. But if we do see some interest rates, we're going to drop. We probably will see a bump in the stock market unless it's as a reaction. If it's a proactive
Mm-hmm.
move, I think definitely we'll see some positive moves in the stock market, and the bond market will also react positively as well for that. And we have adjusted things for that. We took our 2024 and 2025 funds and moved those out on the calendar a little bit. And a quarter ago, we extended the maturity and duration of that bond portfolio as it is to take advantage of those potential interest rate decreases, whether they happen in 24 or 25 or beyond that as well. So we think the bond
Mm-hmm.
market is in a good position to generate some positive returns for folks, barring some catastrophic thing as we go. Dan, any final thoughts today?
Nope. Be a interesting rest of the year.
Yeah, absolutely. Well, thanks for joining us. Here in a couple of weeks, we're going to talk about the emotional side of investing and why fear and greed and even the fear of missing out is not a thing that you should really be concerned about. And that'll be here in 2 weeks. So please check back for that. If you'd like more information about our firm, visit our website, cfswv.com. You can find out how to reach out to Daniel, myself, or any of our other advisors on staff. And catch past episodes